How much is your mortgage payment on that $400,000 house you want to buy? Don't panic. By the end of this video, you're going to be able to calculate your mortgage payment on any price house you want to buy.
Okay, boy, I'm beating my best, I know. Feeling the buzz, living my life, dancing, let's make some noise.
We're talking about all the elements that make up your mortgage payment. This is one of the most common questions I get. Most folks trying to buy a house do not know what their mortgage payment will be. They don't even know what the elements are that make up their mortgage payments. There are four primary elements that make up your mortgage payment. It's the principal, interest, taxes, and insurance. And then under the insurance category, there's PMI or MIP, depending on if you're going conventional or FHA. So what I'm going to be using today, guys, is nothing fancy. It's a free calculator at mortgagecalculator.org. I'm going to leave a link to it in the description if you're watching this video on YouTube. So right up here, we're going to punch in 400,000, right? And we're going to say 5% down is what we're going to be using, right? Because you can put 5% down. Really on an FHA, you only need 3.5% down. On some conventional loans, you can put as little as 5% down. So let's say on a $400,000 house, we're putting 5% down, which is $20,000, which would make our loan amount $380,000. Interest rate here, we're going to change that because I don't think that's what today's going rate as of the recording of this video. Let's take a look at what mortgage rates are. All right, so as of March 8th, 30-year fixed is 4.52. All right, so let's just round to 4.5. All right, so let's go back to our mortgage calculator. Let's put in 4.5% as our rate. We're gonna say 30 years, that's correct. Start date, we'll do May. Right? We're pretending like we're buying the house in March. So 45 days out would put us right around May. Property taxes. All right. This is a big one because this is the most common one that makes a difference in your mortgage payment that people invariably overlook, right? This is the one that gets people saying, well,
how come my friend bought a $500,000 house and his payment is less than what my mortgage payment's showing?
And this is usually the culprit because the taxes on that property can be way less than the taxes on your property. There are many different factors that influence what your taxes are, right? The school zone, when was the home built, and I could go on and on and on, right? So for the purposes of this video, we're gonna use a tax amount of, let's just say $6,000 annually. And let's say your friend or family member bought a house and the taxes are only $2,000, right? $6,000 a year, that's $500 a month just in taxes alone that's being added into your mortgage payment. Whereas someone with a $2,000 or $2,400 annual property taxes, their taxes are only $200 a month. So the next thing we're going to look at here is PMI, and I want to talk about this a little bit. PMI is private mortgage insurance, and it's not like your homeowner's insurance that protects the actual property. PMI actually protects the lender. And if you put less than 20% down, you're going to need to carry it. The FHA version of it is called MIP, and there's a different calculation for that. But keep in mind, this is something you're going to need if you put less than 20% down. This can vary greatly depending on the lender, depending on your credit, depending on the size of the loan amount. It can be anywhere from 0.25% all the way up to 2%. But I think a safe number that we can use is 0.5%. All right, so for the purposes of this video, we're just going to say 0.5% is what our PMI amount is of the loan. The next thing that needs to be factored into your loan is your homeowner's insurance, because most of these annual premiums are going to be escrowed by your financial institution. Most financial institutions are going to require that these are put in escrow. What do I mean by that? You're paying them and then they disperse payment to your county tax collector's office. They disperse payment to your insurance company. They want to make sure that at the end of the year when it's time to pay your taxes, you don't have a problem coming up with the money. So they collect it over the course of the year so they can disperse it at the end. And let's say your mortgage premium is going to be $3,600 a year. Now let's just say your HOA is $300. All right, we're just going to use $300. Loan type, conventional. Let's just review. We've got a $400,000 house. We're putting 5% down, which is about $20,000. Our interest rate is 4.5%, amortized over 30 years. $6,000 a year property taxes. PMI, we've got 0.5%. $3,600 a year for our insurance premium. So let's just hit calculate here. And we can see here, payment with PMI, $3,183.74. So a $400,000 house with roughly $20,000 down, 5% down, is about a $3,100 a month mortgage payment. You see here, that's your monthly mortgage payment. It says the payment here after 99 months. Why does it say that? Because that is the amount that's going to take you to the under 80% LTV that is required before the mortgage insurance can be lifted. That's why you see this number go down here, because it tells you right here what your PMI payments are individually. If you're in a conventional loan, even right now, and you're below that 80% LTV, meaning your loan balance is less than 80% of the value of that home, you can call up your mortgage banker and say, hey, I think I am below the 80% threshold to get mortgage insurance dropped from my mortgage payment. And they should walk you through the process of how to do that. So you can get an additional $150, $200, however much your MIP or not MIP, however much your mortgage insurance is, because with FHA, when it's MIP, that actually can't be removed. And that's one of the disadvantages to an FHA. You cannot remove mortgage insurance from that loan. You would need to refinance out of that loan into a conventional loan. We see our down payment here, our down payment, $20,000. The loan payoff would be in 2052, which is 30 years from now. I'm going to do a separate video on how to maximize your payments on a mortgage to pay it off 5, 10, even 15 years faster. You see here, based on the $6,000 annual property taxes, how much your monthly tax amount is. I want to emphasize that because that is the thing that is most overlooked. A lot of folks think they're going to have like a $2,000 a month mortgage payment, and they're trying to figure out why is it $500 or $600 more than what I thought it would be, and that's the culprit. That's one of the culprits, right? The amount of the taxes. Whoever the real estate broker is that may be helping you, hopefully it's me. You want to make sure, ask me, hey, what are the taxes on that property? Call your homeowners insurance. Tell them to give you a mock-up of what your insurance premium is going to be annually. Reverse engineer maybe how much house you can afford. Maybe you want to do it backwards. Maybe you want to say, you know what, my budget, my max budget is $2,500 per month all in. So reverse engineer it, right? Let's play a scenario right now. Let's say $300,000. All right, let's see, with 5% down, 4.5% interest. Let's use taxes of $4,000 annually. Insurance, homeowners insurance, let's leave that there. Let's bring the monthly HOA down to $200 a month. All right, and let's hit calculate. All right, and that gets us there. You see here, right here, our payment with PMI, $2,396. So if your max is $2,500 all in with principal, interest, taxes, and insurance, including HOA, everything, you're like, I don't want to spend more than $2,500 for whatever house I buy. There's your formula. Right? You know that you cannot exceed a $300,000 house. Well, maybe you can. Maybe you can go a little bit more. Maybe if we did, let's say, 320. Let's say 320,000. All right, and let's hit calculate again. All right, boom, right there. Man, I'm good. So if you wanted to stay right around $2,500 per month for your mortgage, you would need to be around a $320,000 house right? With 5% down, 5% down is about $16,000 down. Keep in mind also, guys, that this does not include your closing costs. Closing costs are the fees that you have to pay, title search, etc., that could add up to another 2-3% of the price of the house, right? It could be another $6,000 or $7,000 for your closing costs. So keep that in mind. It's not just your down payment, okay? But if you wanted to stay around that price point of $2,500 a month, you would need to be in the price range of a $320,000 house with 5% down. Your property taxes cannot exceed $4,000. You see it right here. $4,000 a year. And these are the things, these are the conversations that I have with first-time home buyers when they're looking to buy, right? When they're trying to manipulate the numbers and why can't I buy this house and keep my payment? And I have to go through these numbers with them and show them why. It's because, yeah, the house is $320,000, but the taxes are $7,000 a year. So that puts you at about $2,800 a month for your mortgage payment. And that's why you're going over, because the taxes are more. Or something like maybe the monthly HOA is $400 a month as opposed to $200 a month. So I know I usually ask you guys to share this video with someone you think might find it valuable, but this time I really mean it. Share this video with everyone you know who is in the market for a house, who's looking to refinance their house. There shouldn't be any guesswork. You should know it'll help you put you in balance with what your budget is, and there's no surprises when you do find a house that you like. Don't forget to like, share, and subscribe. Thank you for watching. Take care.